All right, well, welcome again, everyone. I know we probably have some folks who are still joining, but we'll go ahead and kick off today's webinar. So thank you again for joining us this afternoon, at least on the East Coast. We are excited to be restarting our webinar series on opportunity zones, and I think there's no better topic to cover than kind of a market update of what's going on with OZs through the end of last year. And I am excited to say that we are joined by Michael Novogradac, managing partner of Novogradac and Company, who will share some of the highlights from a recent special report that his firm published last month on the investment activity in the opportunity zones market through the end of last year. I skipped introductions of myself. I'm Catherine Lyons. I'm the Director of Policy at the Economic Innovation Group. And I'm also joined by Rachel Riley of Aces and Archers, who will help moderate this webinar along with myself and take us through a few updates. So Amelia, if you wouldn't mind going to the next screen. So our agenda for today will cover opportunity zones resources, a market update, starting with a year in review, especially on the policy front, kind of what did we see from Washington and from the federal government in terms of OZ activity. And then we'll move into insights on investment activity from Michael, and then also hit some market highlights as well, and then go into what can we expect for the year and the years ahead. And so we'll have an opportunity for some moderated Q&A as well as Q&A from the audience as well at the end of the presentations. So that's a housekeeping note that if you do have questions throughout this presentation, throughout this webinar, please use the Q&A function. It's a little easier for us to track so we can make sure to get to as many of your questions as possible. So please use the Q&A to submit questions at any point in the presentation. And this is being recorded. So we will be posting a recap of this webinar and a recording of the webinar as well on our website shortly thereafter, and we'll circulate that to every registrant and attendee. So starting with OZ resources that we wanted to highlight. So a few recent clips from the market. The Verte Opportunity Zone Fund, which is a just kind of fantastic fund and model of investing in operating businesses across the country. They recently announced an investment into Uplift Solar. This is a Las Vegas-based business, and they developed lower power waterproof panels for transportation and military customers especially. Specifically, they kind of work on the circuit component that will optimize kind of power usage and expand the applications for solar energy. This is just, I think, something we wanted to highlight because Verte continues to make not only investments into operating businesses, but especially ones with a clean energy focus. And it's exciting to see that Opportunity Zones investments and capital are being used to support businesses that have that component as well. In the Tampa Bay area of Florida, a regional business incubator broke ground recently. It'll be a 45,000 square foot facility with a projected 2023 completion date. And it will house and be the home for startups and tech companies in the Tampa Bay region. It's located in downtown St. Petersburg in their opportunity zone as well as in their innovation district. And the project received support from numerous partners, including the Economic Development Administration and the city of St. Petersburg as well. So again, interesting model, kind of public-private partnership that is supporting entrepreneurship and companies that can be located in an opportunity zone with this facility, and hopefully therefore qualify, as an opportunity zone business and be eligible for a pool of capital from, OZ investors as such. So exciting developments there. Finally, wanted to highlight Ross Baird of Blueprint Local and the innovative model that his firm is pursuing for equitable real estate and really kind of early stage real estate development is how he describes it. He has a lot of experience kind of investing in early stage companies prior to his work with opportunity zones and early stage companies in many of these same kind of distressed and underserved communities. He's applying a kind of a similar concept of investing at the early stage, but for real estate, and doing so in places and kind of Zoom towns, as the headline suggests, places that are kind of some of these second tier markets, but pursuing very impactful real estate deals, for many of these communities that haven't been kind of recipients of kind of an infusion of new capital, especially for kind of improving their built environment. So that it was a very kind of insightful interview from Ross on their strategy that was worth highlighting. We've included this in a few different webinars in the past, but worth re-upping these resources. EIG has several updated fact sheets on investment activity in opportunity zones, although I think there's probably some new activity, as we'll hear about later in this webinar, to further update. Some proposed legislative improvements from our Opportunity Zones Coalition kind of group of stakeholders that we've proposed to further improve the policy and make it more effective for these communities. And finally, a fact sheet on the socioeconomic characteristics of opportunity zones communities as well. Our last webinar was in December 2021. It was a great conversation on how to invest in local opportunity zones and drive Main Street revitalization. And we had folks from Brookville, Indiana and Harvey, North Dakota, to share how they are pursuing a really creative opportunity zone strategy to revitalize their Main Street, kind of fulfill some of their community goals around that. So that recap is there as well. Rachel, I believe, has posted all of these in the chat. So if you're seeing links pop up, all of those correspond with all of the clips and the fact sheets and the recaps that I just mentioned. We can go to the next slide. Great. So I'll kick things off with just a year in review, again, more from a kind of policy federal agency perspective. So we started the year off with a further extension of relief to opportunity funds and their investors, again, due to the COVID-19 pandemic. We saw this relief extended first in 2020 when it became clear that meeting some of the statutory timelines was going to be quite challenging in the middle of a pandemic. IRS continued to extend that relief at the beginning of the year as well. In May 2021, as well, IRS its announcement confirmed that the boundaries of existing of designated OZs were unaffected by the 2020 census changes and were not subject to change. That was certainly a looming question, as the 2020 census and the results of that census, became public, and of course, census boundaries change to reflect the changes in population. And so there were lingering questions about how this might impact opportunity zones. Would the boundaries change? Would they expand or contract? IRS came out and confirmed that the boundaries of designated OZs will not change. So that was helpful guidance. In November, the Government Accountability Office, the GAO, released a report that included a really significant analysis of the policies efficacy to date. It talked about the characteristics of opportunity zones, noted that they were quite well targeted, which a lot of our research had already borne out, but it was helpful to see that validated by the GAO. It also had a survey of some opportunity funds about their use of opportunity zones and the policy, what's worked, what some of the challenges have been, and generally found that it certainly made projects happen that wouldn't have without the incentive, or if projects were already underway, kind of further either accelerated the project or made it more impactful, kind of deepened the level of affordability, that kind of those kind of elements. And so and then finally, it also surveyed states. So it was good to hear from a state perspective, which overwhelmingly felt that thus far the policy has had positive effects. So it was a very comprehensive, I think, look at the various aspects and the various players within the OZ market. And finally in December, at the end of December of last year, the 5-year tax benefit effectively expired. So that step up in basis benefit, a 10% step up in basis benefit by which you would receive if you held your investment for at least 5 years, expired at the end of last year. Finally, taking us into just last month, the Treasury Inspector General for Tax Administration released its evaluation of IRS's processes for ensuring that qualified opportunity funds meet program and reporting requirements. So this was less of a look at the policy or opportunity zones itself, and more so a look at the agency, IRS especially, or specifically, and if it has the kind of appropriate and the processes in place and capacity to ensure that investors and qualified opportunity funds are kind of meeting the statutory reporting requirements. So that takes us through today. And I will turn it over to Mike Novogradac to share more again about the highlights from the special report that was published last month on the investment activity through the end of last year. Mike, I'll turn it over to you. Thanks again for being here.
Thank you, Catherine, and thanks to EIG for hosting this webinar and the series of webinars. I appreciate the opportunity to join you and discuss the results of our recent report. This is a semi-annual report that we started in early 2019 to issue on a sort of regular basis, on a semi-annual basis. And it goes through and surveys opportunity funds and the data and the amount of equity that they've been raising, as well as where they're investing the funds. If you go to there we go. And the top line number, as many of you may have seen from the press releases and all the rest, it is a kind of multi-page report that is available for purchase on our website if you're interested in getting more of the specifics. And we also will be discussing this in more detail at our Opportunity Zones conference in Long Beach, April 20th and 21st. So you can go to our website if you want more detail on that upcoming event. It will be both in person and streaming, so you can choose whatever your preference is. And it is in Long Beach, California. It's in an Opportunity Zone. So the top line number in terms of the amount of equity raised cumulatively is $24.4 billion. And I want to say a bit about where we get the data. Where right now we have fundraising data on 978 funds. We actually are tracking over 1,300 funds, but we don't have specific fundraising data for roughly 400 funds. And this is data that we collect, and it's basically voluntary. So I would like to thank all of you that are joining this webinar who are participating in our surveys. We do reach out to the funds and we submit surveys, and we appreciate the time and energy you take to respond to the survey. It is really helpful, and we're trying to not have a survey that is too difficult to comply with, but we are trying to get as much data as we can. And we basically collect data on the fundraising amounts that each fund is raising, as well as where they're targeting investments, both in terms of the types of investments and in the locations. We'll talk about that more in a moment. But it is data that is voluntarily given to us or is publicly disclosed, such as in the SEC filings. And a large portion of the 300 plus funds that we don't have data on are coming from those SEC filings. We do every year get some of those that we've tracked down and reached out to actually report specific capital raising amounts. But once again, thanks to all of you who are taking the time to participate. Someday I hope that we will have more reporting, some sort of reporting requirements, such that the Treasury itself can be releasing data on that's exhaustive, if you will, or covers all the qualified opportunity funds. So this is clearly a subset of the capital that's been raised for investment in opportunity zones, but we do find this information really useful, and I do think it's pretty insightful in terms of the areas that these funds that we're raising data from are investing. So if you go to the next slide, you can see that from a cumulative basis, the last 6 months, to no surprise, were a dramatic increase in the reported equity raised. It was up nearly $7 billion over the last 6 months of 2021, which is the largest over any measuring period that we have had in the past. And then, as you can see, in terms of the investments that they're choosing to make on the next slide, that residential rental, of course, not for sale as much, but residential rental does tend to be is the largest category. And as you can see on the graphic, nearly $5 billion has been invested in funds that are only investing in residential rental housing in opportunity zones. And I will say that there are a number of funds that will be, say, residential and commercial, or say commercial and operating business and the like. So we collect both the information on residential only, but also the funds that are investing in residential and, say, commercial, we collect that data as well. So you can see also there that roughly 19 billion is either residential only or residential and some other investment type. And then if you, the fact that it's residential rental, go back. So just to go back one more, there we go. So I just wanted to talk a bit about commercial and the other categories here, and then we'll say a little bit more about the details of the residential rental. But I just wanted to broadly say within residential rental, it certainly wasn't a surprise for us initially that so much investment was going into residential rental in the early days of the opportunity zone investing. That is the area that's easiest to get your handle around in terms of underwriting. And then since then, there's such a significant housing crisis in America today, it's not a surprise that capital continues to flow into residential rental, and then obviously residential rental located in opportunity zones. So it definitely, does to me mean that the opportunity zone incentive is doing something in terms of helping, fund new construction of residential rental in opportunity zones or substantial, real heavy renovations, even though most of this is all new construction. There's also significant dollars going into commercial. The commercial only funds roughly 1.65 billion, but nearly 16 billion of those doing commercial and other activities, generally commercial and residential rental. Obviously, lots of mixed use developments, sort of ground floor retail or ground floor, particular uses. And then, as you kind of grow up, you have the residential rental properties. And then hospitality, roughly 3.5 billion of hospitality and or other, about 633 million of hospitality only. There was a bit of an uptick in this last report for hospitality. As many of you know, initially hospitality was a notable category of investment, but then with the pandemic, a lot of the hospitality investments ended up kind of redirecting their funds into non-hospitality investments, given the impact of the pandemic on hospitality. We are seeing a bit of a comeback in terms of hospitality fundraising, which also probably reflects the current state of the pandemic and the beneficial that where we are in the pandemic, making hospitality in the near term a more opportunistic investment. And then renewables is another category that we track. And the renewable investment, there's less than 200 million of renewable only funds, but nearly $500 million or more than $500 million that are looking at renewables in the context of other investment types. And renewables have a lot of interesting aspects to opportunity zones, which I won't go into here. And then operating businesses, we can talk more about later, but operating businesses and fundraising for opportunity businesses definitely continues to lag some of the other categories. But those that are doing operating businesses or other investments, is approaching $1 billion, which is sort of pretty significant. And we also believe that the the scalability of raising capital for investment operating businesses isn't as great as some of the other areas. And we can talk more about that later. It's definitely something that we at Novogradac, and I know EIG and Opportunity Zones Coalition and others really want to try to grow and take steps to incentivize changes in regulations that could help incentivize more investment operating businesses. But let's move to the residential rental slide, where we kind of break out, what type of residential rental we're seeing. And no surprise, multifamily residential rental is the largest. There is a small subset of single family residential rental. And then we also, as part of our survey, we ask and this is where the survey starts to get a little bit more involved, and we appreciate once again all those who take the time to fill out the survey. What portion of the multifamily or single family is income restricted? And nearly $5 billion of the investment is going into income restricted properties. And overall, we also have about over $1 billion that report that their multifamily is workforce housing. And I will note that in the broader category of multifamily rental, the nearly 17 billion, a lot of times when we think of that and it's not income restricted, people think of market rate, they tend to gravitate towards luxury. And I would just note a large amount of this multifamily rental investment, while it isn't income restricted, it also isn't sort of high-end new construction. It's more moderate income new construction. It just doesn't have income limits, so it's considered market rate multifamily. And then moving on to the next slide, we sort of have talked about the overall capital raised, and we've talked about the different categories of investment. And we also asked the funds where they're planning on making their investments. And what you see in front of you are the top 10 states or 9 states in Washington, D.C., where the planned investment is. And some of them, clearly aren't a surprise. Opportunity funds themselves are naturally going to be more likely to invest in areas with large populations or states with large populations. So you can look at California, Texas, Florida, New York. I always sort of think of the presidential election and electoral college. Where are the electoral votes? That's where you'll find, whenever you're doing any sort of statistics about, capital investment in states, that's generally what's going to govern. Ohio is definitely there. It is a relatively high population state. It also has a state incentive that we do think does incentivize more opportunity zone investment in Ohio. And I would just note Colorado and Arizona and Washington also have some significant investments, and then Washington, D.C. And Maryland. So those are the 10 states are getting the most investment. And once again, this is the most investment from our survey, which is a subset of the entire universe of equity investment. We think the universe is, probably three or more times what our data collection is. When you look at the cities, you can see Sacramento, Los Angeles, Salt Lake City, Phoenix, Austin, Atlanta, Georgia, Nashville, Tennessee, Baltimore, Maryland, Washington, D.C., and New York City. And I would note that all of these are driven, at least in part, by multifamily residential rental investment. That there's significant demand for multifamily residential in these communities, and there's significant dollars going in to residential rental. I'll also note that there are a number of these cities that aren't, driven predominantly by residential rental. There are also a number that are also, seeing sort of office investment. And I would just point out Washington, D.C., New York, Nashville, Baltimore, Atlanta. Those are some of the areas where we're seeing, notable office investment that's, helping drive those cities being in the sort of top 10 of what we've noticed. And then going to the next slide in terms of, kind of going through the report. Obviously, by virtue of tracking the funds and where they're investing, both geographically and sort of investment business type, we also end up with data on what the amounts raised by qualified opportunity funds. And to no surprise, the vast majority of the opportunity funds, have raised, 10 million or less. So there are a large number of sort of single property, single city funds that end up raising, up to that are in our sort of up to $10 million category. Basically, they're raising the amount of equity needed to pursue that investment in that community. And then, as you get to the larger fundraising amounts per fund, you don't see quite as much per fund. You don't see quite as many funds, obviously. And so when you look at a $500 million or more fund, there's obviously not quite the volume in terms of number of funds. But when you look at where the capital is getting raised, it is clear that the largest opportunity funds have raised more than half the capital. So you can see in the slides sort of in front of you, those funds that are raising 500 million or more are nearly $8 billion in terms of equity raised. And those in the $100 to $500 million range are roughly $6 billion. So we basically, when you're looking at the investor sort of market of funds themselves, we basically see almost like a barbell, if you will, in terms of the funds themselves, from the standpoint of equity raised. On one end of the barbell, you have the large national multi-asset funds that have raised more than half the capital. And then on the other end of the barbell, you have, in terms of number of funds, dramatically more funds, over 600 funds that have raised less capital, obviously. And then they also tend to be single asset, single city funds. So you have these multi-asset funds on one end with large capital per fund and very diversified across the nation. And on the other end, you have those, greater volume of funds that have a single asset, a single location, and their dollar amount raised isn't as great. And then there are, a lot of exceptions, as you'd expect. I'm sure a lot of you are thinking, well, my fund doesn't quite fit in that category, or what I invested in doesn't fit in that category, or the investors I see in my community don't fit in that category. But those are the two themes that come away. But there's definitely, funds out there that might be, well over $100 million for a single investment, in a single city. And then there are also regional funds and multi-city funds and the rest. But in terms of broad overviews, you do have this sort of barbell type view of the equity raising market. And then going to the next slide, I just wanted to highlight in the report, we do have some historical information. And as we kind of walk through this slide, and you'll see a little line circling some of the different graphs, it helps highlight. So you can go ahead and there we go. And this kind of shows you what I was saying about the single city fund being 7.28 billion in single city, and they tend to be single city, single asset. And then the nationwide is roughly 6 billion. So you basically nationwide have, a large amount of capital raised in investing nationwide. And then you have a number of funds that are investing in a single city, which can lead to pretty large capital amounts. And the other that I would sort of point out is multiple city, 6 billion is interesting. And then you can see the other data, which isn't as significant in terms of regional types of funds and multiple state or single state. And then on the next, going to the next slide, I just wanted to, just remind you that the full report is available. We also have other resources on our website. And at this point, I didn't see any questions in the chat. So I guess I'll hand it over to Rachel.
Yeah, thanks, Mike. As you're going through this data, and I've heard the data and I've read, the report overview. It's a lot of data, right?
Yes, it is.
To consume at one point. And so I do encourage folks to think about where there may be questions, where you would love some additional insights from Mike throughout the remainder of the webinar. Please put them in that Q&A box, as Catherine mentioned. But Mike, I guess if you would have to summarize all of these different data points and kind of paint a picture about 2021 and where we may be headed for 2022, is there just like, the soapbox statement you may have for folks?
Yeah, the soapbox statement. Well, I guess the the question that we get a lot is how significant was the 10% basis step up in terms of driving investment into 2021, and to what extent do we think in 2022 and beyond we're going to see some waning or some diminished amount of investment. And as you've heard me say many times, Rachel and others on the webinar, the basis step up is a small portion of the overall benefit of the incentive. The incentive has the basis step ups, it has the deferral until 2026 of the gain, and then it has the fact that any appreciation in your investment, if you hold it for 10 years, isn't subject to tax. And that is the fact that you can hold the investment for 10 years and it may not be subject to tax on the gain for that you help to realize making an investment opportunity zone. That is the significant feature of this incentive and this significant value proposition. And the basis step up, is maybe 30, 40, 50 basis points. It's not going to be enough, to cause one to make an investment they wouldn't otherwise sort of make. But it is something that, might affect your behavior from a minor timing perspective. It's really the 10-year hold that makes the benefit, that makes this so strong an economic incentive that it is. I will note that having that basis step up, is a feature. It does allow to incentivize accelerating the capital, and that's what we did see at the end of last year. I think there were a number of investors that had their 180 days. It wasn't going to expire until 2022, but for that incentive, they might have waited until early 2022 to make the investment. So I do think we saw a bit of accelerations from those investments that might have been made in January, February, or March into the end of December. So I do expect there to be a bit of a softening, if you will, in early 2022 because of all that accelerated investment. But then I think we'll be back to where we were before or beyond in terms of equity raising. And I think that'll continue up until 2026, absent some other black swan or extraneous event that can happen. So but I generally think we're on a trend right now to go that way. And I look at the nearly $7 billion that we have been able to report being raised in the last half of 2021, that the real driver is the maturation of the market and the fact that more investors understand the concept of opportunity zones, the opportunity of opportunity zones, and there are more funds further developed in the distribution channel to make themselves available to investors. And I don't see anything that would cause that to wane in the sort of months and years until 2026, in the event that that becomes the final date to be able to invest in opportunity funds. I'm hopeful, as I know you are, that there is an extension of the opportunity zone incentive such that we'll have time beyond 2026 to make investments in opportunity zones, as well as potentially have an opportunity to invest and qualify for the 5-year benefit, or that go back and even get the 7-year benefit as well. Mm-hmm. That's kind of our sort of general take in terms of the results of 2021 and what that would mean for 2022 and beyond.
Yeah. So basically the 5-year tax benefit, the expiration of that may have caused some accelerated decision-making, but the increase in volume is more of a statement of overall market activity and where we are as a marketplace. And it's not too late to get involved with opportunity zones. I know a lot of folks in communities and otherwise feel like, okay, they missed this final deadline. There's no point in paying attention, but there's still going to be continued activity for the coming years. And if there's an extension beyond that as well.
And I would note that, one of the more interesting, there's lots of interesting, I shouldn't say more interesting, because there's so many different areas you can go down and interesting takeaways from the study and from just having discussions with the various fund managers, is that, initially, a lot of funds were, had to get up and running, and they had to get into the distribution chain, if you will. So the fundraising part was, the most significant, going through the education and all the rest, a whole host of different parties. And now that all that is sort of up and running, and they've raised lots of capital, as you see, over 24 billion that we can identify, and they've made lots of investments in opportunity zones kind of across the country, that the search for investments is a lot more challenging for these funds than it was a year ago or 18 months ago, which I think is a really sort of positive sign that the funds have went out, they raised capital, and the capital raising part was a significant, you had to get the wheel turning, if you will. And once that wheel was turning and the capital raising was going, then for many funds, the greater challenge becomes finding the investment opportunities throughout the country that are in opportunity zones, which I just take as a really good sign for opportunity zone incentive achieving what it is it's designed to achieve.
Yeah, and I know we have a section coming up pretty shortly here that's talking about what lies beyond, for both 2022 and the coming years. And so maybe we can talk a little bit more about, as folks are trying to identify new investment opportunities, develop and redevelop their pipeline, what that could potentially lead to. We're getting a lot of questions. I'm so glad that this conversation prompted folks to ask questions. There's some that are more technical in nature, but there also are a few that maybe, Mike, I can just ask you before we move on to sort of the highlights section of the webinar. So there's one question from Eric Yost that's asking, you're tracking data around investment activity. Do you have any plans to track the social impact? Or I know the impact of opportunity zone investments is hot on the minds of a lot of folks. So just curious about what the feasibility of doing that looks like.
That is a great question. And we're constantly, in terms of doing our survey, and the reason why I want to give props to those funds that are participating in our survey is how we're trying to strike the right balance between asking questions to get core data and not burdening the funds with additional data. And I will say that right now we have an approach of asking for some top line data and then following up for those that are sort of more open and more responsive to also provide that a broader range of the social impact and a broader range of social impact data, because obviously some of the data we collect already is. But I think that absent there being some reporting burden obligation on behalf of funds, it's definitely a challenge to collect that data.
Yeah, and I think a lot of these projects are so early in their existence that it'll take a year or two before we can even understand what the potential impact, the actual impact, as opposed to economic projections may be. Another question here is asking about the breakdown of the types of renewables and operating businesses that you're seeing. So are you seeing investment activity clustered in solar energy? Are you seeing investment activity clustered in, tech operating businesses? Are there any general themes that you're seeing?
Yeah, I would say that the operating businesses is pretty varied. I don't know that I'd identify any particular trends there. On the renewable energy, it does tend to be solar. There's a lot of reasons. There's a lot of attractiveness to solar energy, and there's some structuring benefits. So there it is, solar. But the operating businesses, they tend to be smaller investment amounts, and it's more disparate, if you will, in terms of the types of businesses, which is a good thing.
Yeah. Excellent. There's a question about what the perspective is or the chances are of an extension. Maybe we can leave that to the later part of this conversation, because I feel like that's going to be a hot topic. There's another question asking about, can you comment on the 30-month requirement and extensions given because of COVID and the federal declared natural disasters? Maybe this is just a general comment, or whether or not some of those waivers are still in effect.
Yeah, all that's a lot to unpack. So I guess I'll just, in terms of that question, uh, I would say that from the standpoint of our fundraising, is I don't know to what extent that affected fundraising per se. It definitely ended up affecting, how funds move their money into businesses. In terms of having some opportunity to not have to rush to make the investments, which is a good thing. But there are a lot of issues at the operating business level in terms of how that guidance applies at the operating business level, and when the operating business needed to qualify, and the fact that the fund maybe didn't have to make the investment, the qualified business did need to still be a qualified business within a certain period of time. So I don't think I can do justice to that question in just a handful of comments. I'm afraid of too many pieces I'd leave out.
Fair enough. I'm going to ask one more question, and then feel free to answer the other questions in the chat and in the Q&A as we continue forward. But the last question I'll ask you, Mike, is whether or not you're seeing a lot of investment activity occurring in rural communities. I know EIG certainly is tracking that. And just any general advice you would give to folks leading economic development efforts in rural communities pertaining to attracting OZ investment.
I think this kind of goes back to my sort of comment earlier about, funds, getting the fundraising mechanism sort of in place to where they're now, looking at their fundraising and saying, where am I going to invest these funds? So versus initially it was all about getting the fundraising going. And there are a number of funds that are now, so the greater challenge is finding the locations and the property and the asset types to invest in. So I do expect, as a trend for 2022 and beyond, I do expect an ever broadening number of geographies that will receive investment from these funds. I mean, I think some of the data we have on the geographic diversity of investments already, I think, is really strong. Sometimes, folks will criticize, the number of geographies that are showing investment now, and I just can't help but, want to shout how this is a new incentive. There's a lot of geographies that are eligible, and, let's see how, in the course of time, opportunity funds reach, broader and broader communities and more geographies. And I do think that we're sort of seeing that, and sort of the economics of the incentive itself, lend it to that happening. So I do think we'll continue to see expansions in terms of more geographies getting covered, with obviously including sort of rural communities. I also think that'll lead to, from an asset type perspective, as we see a large amount of multifamily, I do think over in due time that'll become more diverse as well. And I did want to also, we touched upon earlier on operating businesses, and I did want to note that there are some, from a pure dollar numbers, and some, we talk about, big dollar numbers, but in terms of, operating businesses, we have seen over the last, reasonable period of time, roughly 10 to 20 funds being formed that are raising, roughly $20 million for operating businesses. And, it's, the dollar numbers are small relative to the overall dollars, but when you think of those funds going out and investing in operating businesses in opportunity zones, that could really start to multiply over time. It was a good development to see.
Yeah. And to your point about scale, and we'll talk about scalability and potential regulatory changes that are needed. When you're thinking about what an operating business needs by way of an equity investment versus what a large real estate project needs by way of an equity investment, you kind of have to think about that proportionally and just understand that it's a disproportionate amount, which may be one of the reasons why the numbers are smaller for operating businesses.
I will say, I can't help but get on my soapbox
Yes.
that, when the regulations were being written, we specifically asked for funds to have a longer period of time to invest their capital, much like you have in the new market tax credit incentive. And that there was pushback from Treasury, and they basically said, we'll let you put the money in a business, let the business hold the money, but you can't hold the money at the fund level. And that really does create a detriment for investments in operating businesses. So if we ever can get that, a reg project going and get that change made, I do think that would be very additive, because the investments in operating businesses, there are a number of regulatory provisions that we, and I know EIG and the Opportunity Zones Coalition were trying to get, that weren't put in the final regulations that have muted the amount of investment going into operating businesses.
Yeah, absolutely. All right. Well, thank you so much, Mike. Please stick around. We're gonna tap you in probably about 3 or 4 minutes, so don't go anywhere. And one last thing before we move on, but we can stay on this slide, to the question about rural economic development officials attracting OZ capital. I will reference the webinar that we did in December, that EIG did in December, and we linked to at the top of the webinar. And that one was on investing in local opportunity zones to drive Main Street revitalization. And we looked at, we had guest speakers on from Brookville, Indiana, as well as Harvey, North Dakota. Harvey, North Dakota is a town of 1,700, and they have spurred investments and opened up new investments over the past couple of years, totaling 31 new businesses. So there's a there, and they share all of their expertise on that webinar. So go check that out. All right, so I feel a little out of breath because of all the information we just shared. And what I really wanted to do before we move on to the look ahead is to just really celebrate some of the great models and strategies that were implemented successfully this past year and highlight some of these projects. So the first one that I have here is a project in Cincinnati, Ohio called the Willkomen. And not only is Cincinnati my new hometown, so I love walking by all the signs that say Willkomen and pointing to them and saying that's OZ financed to everyone who doesn't want to hear it. I still do that, but it's also a very great project because it kind of answered this question of how well can OZ financing blend or twine with the federal low-income housing tax credit, new market tax credits, historic tax credits, etc. This is a scattered site, multi-phase project, and so the structuring of all of these different sources of financing was very complex, but the answer is that OZ financing indeed can be used alongside. This is part of a broader strategy. And so I'll drop links to the webinar where we talk about that momentarily, in case you guys wanted to take a look and understand that project a little bit better. We also, early last year, Rev Oz, an opportunity fund based in California, announced their commitment to intentionally achieve measurable impact with its opportunity zone investment strategies. So they really dove in on the impact side. They established a social advisory council. They started using economic projections and an impact screen to understand the potential impact of those investments. And in some cases, they decided not to make investments because it didn't meet the certain criteria threshold around impact. And so even though they were a little more selective with the projects they invested in, they have, I believe, either met or gone above their original commitment of $250 million in OZ financing to leverage $1 billion through social impact investment strategies. So congrats to Rev Oz on that. We also last year in a webinar highlighted this project called the Phoenix Community, which is a joint venture with a local nonprofit. The nonprofit had land that it wanted to develop. An opportunity fund manager came in with capital and said, we'll partner on developing this project for you. It's going to provide reentry housing as well as office space for that nonprofit. And at the end of 10 years, the nonprofit has the first right of refusal to purchase the building. And so there's this long-term strategy around the end use of that project that sort of what happens at exit has always been a question in regard to high impact and OZ transactions. And we also saw Arcturus Impact Investors launch their national digital impact platform to expand access to broadband fiber into opportunity zones. We had them on a webinar to talk about that. They worked with foundations as well as a state agency in order to lift up that strategy. And they're doing it in multiple cities. And so it kind of answered the question of how can we utilize OZs to attack some of our nation's most pressing challenges. And I am sure that the recent federal financing for broadband expansion will not hurt that model in any way. 3 more highlights. Opportunity Alabama launched their Opal Fund to invest in Alabama-based real estate projects. They're engaging minority investors in the Opal Fund, and they're also engaging minority and women-owned business enterprises in the development and management of those funds. And so it's really great to see a, I would say like an opportunity zone intermediary mature from just the intermediary role to actually becoming a fund manager and taking a more proactive approach to how funds are deployed in their state. Opportunity Alabama has always been proactive, but with the Opal Fund, I think that they have more control in how capital is guided into the state of Alabama, and they set up really, I think, great benchmarks around how they want to engage minority and women-owned businesses and investors in their community. We talked a little bit about solar energy earlier, renewables. Later last year, we brought on a guest speaker from Hoosier Solar Holdings in Indiana, and they shared their strategy for leveraging OZ financing to expand solar power throughout the state of Indiana. I will drop the link for that webinar, as all these other webinars, in the chat momentarily. And then finally, on the list of highlights, we had Solar Impact come on to talk about their Black Impact Fund, which is intentionally designed to provide affordable housing and opportunities for wealth creation for Black and Latinx residents in opportunity zones. All great conversations that we had last year. We just wanted to take a moment to reflect a little bit on those conversations and mention, share where you could catch up on those conversations if you weren't part of those webinars. But those are sort of the highlights. Catherine, do you have anything else to add, or should we just go ahead and transition to what lies ahead?
Let's go ahead and transition.
All right. Okay, so I think the impromptu Q&A that Mike and I did momentarily kind of addresses a lot of these questions, but I still think they're worth reemphasizing. And feel free to weigh in the chat if you have opinions on these. That's always fun too. We want this to be a dynamic conversation. And so, Mike, we talked about the fact that the increase in investment volume that we saw late last year is more indicative of market maturation as opposed to, a rush on the banks, or however else you would describe it, a rush to invest because of the expiration of the 5-year benefit. So we kind of covered that, but do you think that there are any other factors other than just market maturation and folks getting comfortable with the OZ policy?
No, I think the maturation is a pretty driving force in terms of this, and it's maturation both at the investor.
Mm-hmm.
More investors are aware of the incentive, and they've thought about it, and they've had a chance to get comfortable with it. They've had more, friends and family and business associates that have invested in funds. So it'd be, so there's that whole aspect of the investor side, and then on the fundraising side and the fundraising channels. Those channels, are getting developed, and that they're sort of maturing. And I do think also on the sort of the business side, more businesses becoming more aware. So I do think that maturation in all these different ways is the overarching in most significant aspect of something like this, which is what makes it so exciting to think about what that could mean for the next few years.
Absolutely. And I think that this question kind of segues into a question that we don't have listed here, but we saw in the chat, and I know is on Catherine's mind daily, around whether or not we're going to see an extension of the policy, and what is sort of the long-term prospects of opportunity zones. So Catherine, I don't know if you have any thoughts on that. Mike, please feel free to share your thoughts on that as well.
I'll let Catherine go first if she wants to share. I still have my thoughts, but go ahead, Catherine, if you want to.
Yeah, sure. I do get this question a lot, and you're right, Rachel. It is top of mind. So I don't have kind of too much more to say beyond, I think, what Mike said as well. I think that is a stated priority of the congressional champions, along with a few other kind of policy improvements. So we also know it's kind of the number one, I think, request from market stakeholders on what would be most beneficial, kind of most impactful to the continuation of their work. So I think that that's known on the Hill as well. But it's always hard to say, kind of looking in the crystal ball, like what its likelihood of passage would be. But it's good to see that there's bipartisan support for this. I think, as was mentioned in the comments, there is a bipartisan bill in the House that was introduced to extend the 2026 date out 2 years. So always good to see that there's bipartisan support for something like this. We'll just have to see if that's something that would also be taken up in the Senate. But certainly Senator Scott has said many times that this is something that's kind of a top priority of his moving forward, and a recognition of how helpful that could be, especially given the pandemic, I think, as well. So sorry, that's a bit of a non-answer, but in true Washington fashion, I guess.
And I would just say, in terms of the extension, I certainly do expect there to be an extension at some point in the future. I'm hopeful that it could happen in the near term, and as part of a broader package of opportunity zone changes and updates and modifications and the rest, that there be some sort of a package that gets enough momentum to make its way past 2026, that would include extending it past 2026. But if we don't see that, it could end up being part of traditional sort of extenders. And, we have a wide variety of tax incentives that we work in that have these expiration dates. And the one thing about extenders is, in and of themselves, they don't generally get extended until they have to. So I think the 2026 deadline, if it's done in isolation, it's hard for me to see Congress extending it until it's about to expire, because there won't be as much of a pressure to do that. But if there's a broader tax bill that has other features to it, then I can easily see how that's part and parcel of a larger opportunity zone focused bill, which is a total non-answer. But I kind of, when I'm looking at it, I view it in that way. But I also look at it and say, it's a great question. We need to work on getting it extended and making every effort to do that, but also look at it and say, we have a lot of years left, so we should definitely be focused on using the years that we have.
Yeah, extenders is always fun because sometimes they don't extend things until after they've expired too. So
that is correct. I don't want to scare the audience by pointing that out. I'll leave that to you.
I think the headline is "Stay tuned." Folks are working on it. So I know we are right at time. There was a question, Mike, around warehouses that could potentially be used as cannabis facilities. Feel free to answer in the chat or right now, but I think that this is a broader part of the closing conversation around, are we going to see new trends in 2022? Are we going to see folks, maybe because of pipeline development needs, move into new asset types, move into new geographies? What's sort of your outlook there?
So I definitely think we're going to see ever greater diversity in terms of geographies, asset types, and funding structures and the rest. As you get, once again, the maturation process, every incentive that we work in, as you learn more of the basics, the more issues to come up, more opportunities to identify new ways. And this is all great. And that's a beauty of webinars like this, is we're all trading information and we work at a much rapid pace. And I think opportunity zones really, it's amazing to me how much money opportunity zones have raised so far. And I definitely think opportunity zones is been adopted and all the rest at sort of faster paces than prior incentives. I feel like every tax incentive that gets created works at a slightly faster pace because they have the benefits of all the knowledge base that's been built up in the past. And then in terms of cannabis or sort of marijuana, that's, a ubiquitous question. When you look at the statute, you look at the regulations, and you look at what a quote sin business is, marijuana and cannabis doesn't appear to be there as a sin business. On the other hand, you don't know what future legislation might do, and you don't know. So there's a lot of sort of unknowns about that. So there's these areas that it would be nice to get clarification. Whenever I get asked about the cannabis or marijuana question, and is a cannabis operation, and there's a wide variety of types of cannabis operations, so then we could even spend time talking about what type of cannabis operation you have and how that might potentially impact the application of the various rules. I kind of look at that and just say the only way you can know for certain, and I will point out that there are some members of Congress that have spoken up at hearings and all the rest saying they shouldn't be allowed or they should be allowed, so that raises some of the concern. And the only advice I could ever give somebody on an issue like that is you can say, okay, this is what we think the answer is now, and we really, but absent some dramatic change, that may not be the answer, I guess. Or you can go in and get a private letter ruling from the IRS, and that's always the answer for any technical sort of question. Is I'll go to the IRS, I'll get a private letter ruling. It'll take 6 months, plus or minus, and then I'll know what the IRS's view is. Or I won't know because they'll say I can't rule on it. But that would be my advice there.
It sounds like a rough 6 months to wait for no answer. And do they publish their private letter rulings as an FAQ or to update FAQ documents? Like, how do we know what the
private letter rulings do get published, and then they get released like 3 months afterwards, and you don't know who they block out all the taxpayer specific information. But they do release them. And I will note that I said that kind of the 6 months, you do end up doing a pre-conference where normally you'll get a sense as to whether or not they're going to rule or not.
Mm-hmm. Excellent. All right. Well, stay tuned. Maybe we'll have more information on that in future webinars. Here's everyone's contact information. Feel free to reach out to us to do any follow-up conversations. We're 4 minutes over, but Mike, you, me, Catherine could talk about this stuff all day long. So I don't think 4 minutes over is bad. Thank you so much for joining us, for presenting on the amazing reports that you guys do. It's such a benefit to the industry, and also for sharing your insights for what's to come.
Well, thank you. And thanks for all that you do and Economic Innovation Group does. And for all those who take the time to fill out our surveys. And if you haven't filled out in the past on our investor reporting, please take an opportunity to do so.
Excellent. Have a great day, everyone.
Thanks so much, everyone.